Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, September 29th, 4:49 p.m. Eastern Time, coming to you from waterlogged St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Survived Hurricane Ian. Water came within a foot of our garage, a little closer than I expected, but receding now. Power on, all safe. Glad it's in the rearview mirror. Thoughts and prayers obviously go out to the people that have been devastated over in the Southwest coast. I mean, some of the pictures coming out of there are just mind-boggling, and it's a reminder: do not mess with Mother Nature. So let's get into the market. State of the market: continue to be in a correction. You can see all four bright red arrows over here in our trend gauge. Market leaders, well, there is no market leadership because the market's in a severe downtrend. All five of the major indexes trending below the short-term 21-day moving average, the medium-term 50-day moving average, the long-term 200-day moving average. Pretty rudimentary guide here, but it'll keep you out of trouble and on the right side of the market. You know, early in my career, I had a big bias once I found a sell discipline for William O'Neill. It's like when you get a new toy, you want to use it all the time, and tempted to see ghosts all the time, worry about the market. And this simple tool right here forces me into the market and forces me out of the market. And it's just a matter of staying on the right side. It doesn't matter what I think. I just got to obey the colors and the trends of the leading stocks and the market indexes. So what happened today? Yesterday, beautiful oversold rally. Got some people hoping we might have put in a bottom, but the market took all that back today and then a little bit, at least on the S&P 500. Gap down, undercut recent lows, closed at recent lows. It did hold the overnight lows of Tuesday going into Wednesday when that panic move by the Bank of England put in the bottom for now, but plenty of red to be found today. G6, this is our growth composite, 6 growth ETFs, down 2.3%, S&P down 2.1, NASDAQ 100 down 2.9, Dow down 1.5, midcaps down 2.1, Russell down 2.4, 60/40 global diversified. How's bond diversification working out this year for all you diversifiers? 60/40 global down 1.35%. Bonds are down just slightly less than the S&P is down. And when I say bonds, I mean like the BND or BNDW or AGG ETFs, where you can't take advantage of a bond maturing and getting all your principal back. You've got to deal with the price. And with the yield going higher, the price is going down, and the price is what you get. And then, of course, whatever income is in there, but absolutely not helping anybody out this year. In-house, GROTECTION, we're still flat, all in cash. Our widest lead versus the S&P 500 on a year-to-date basis. So let's dive into these ugly charts and see if we can find anything to be bullish about whatsoever. I will point to the only thing that I can find to be bullish whatsoever, and that's this hook up yesterday. The thin black line is the stochastic, that's the actual stochastic value. The blue line is a moving average of the value. So it appears though we're slightly coming off the lows with the moving average. We hooked up yesterday, hooked down not as much. So there still is, it's like from Dumb and Dumber, so you're saying there's a chance. That's about how I feel like here, but the markets don't go down forever. They will bounce at some point. When they bounce, will it be an anemic bounce? Will it be a low? We don't know, we don't predict. We will follow the price and volume of the stocks and of the indexes, but at least this didn't fail right now. That's about the only positive I can find. And we're not going lower versus the 21-day exponential moving average. We're hanging between like 4.5%. The least recent was minus 3.8% with yesterday's close. Now today we closed 5.3%. At the low today we were 6% below. So that would be a 6% or worse for 5 consecutive days relative to the 21-day moving average. And no, it doesn't have to bounce back higher and get to the 21. You can just go sideways and the 21 will catch up to it. And then you can do a leg lower that way. You can correct through price or through time in the market. So what do we do here at Revere, and why do we do it? We take a look at the overall markets. We focus, I'd say 2/3 of our focus is on the NASDAQ 100 and the S&P 500. And when the market is trending higher above the short-term 21-day moving average, that's the green line, above the 50-day moving average, that's the red line, and above the 200-day moving average, that's the black line, we are absolutely in the market as much and as long as we can possibly comfortably be, because we just know from history this is the time when risk is at its absolute lowest, when you're trending above these moving averages and the slopes of those lines are higher. If we start to go sideways, our stops will take us out of the market a little bit. If we really start to roll over and the slopes of the lines go lower, we'll really start to lighten up, reduce our exposure. And then if we break below this big, nasty black line, that's the 200-day moving average, usually when it is in an uptrend, I've noticed, we've been doing studies of these bear markets, you're still at risk for whipsawing above and below, but when it rolls over, that's bad news. And notice I've been talking about this 421 date for a while. That's when we really gave it up. That was at the peak of the 200-day moving average, and it's rolled over and gone substantially lower. It's got quite a slope to the downside now. And this is going to get us back in. I've done a webinar about just following one rule, and that is, where's the weekly close on the S&P 500? Is it above or below the 200-day moving average? If it's below, get out. A little bit of whipsaw here and here, but we're going to get back in lower than where we exited up here because the slope of the line rolled over. So not only are we saving ourselves from all this carnage, that one simple rule that we used to get out here, that we used to get out in COVID, that we used to get out in Q4 2018, that one simple rule is saving us a lot of heartache and a lot of financial capital. And we're quite stretched to the downside now, 13.5% below the 200-day moving average. As I said, we're hanging in cash. We've been in and out of cash about 9 times. I'm going to go over the stats in our client video that goes out this weekend. But we're quite content to be here because we're going to be capitalizing from such a higher asset base because we avoided all of this nastiness. And it's how we do it here at Revere. And if you're interested in this approach, reach out to us, Dan@RevereAsset.com or Don@RevereAsset.com. Dan and I are the partners, and we would love to talk to you about our approach, or you can call 855-REAL-WEALTH. That's 855-732-5932. So there's your S&P 500. Same rules apply. The second most important chart I'm looking at is the NASDAQ 100, because this basically leads the market up and leads the market down. Same rules apply to this, and the same pattern applies to this too. Lower lows, lower closing lows, still have the little bit of the hook up there. Let's go to the Dow Jones Industrial Average. Not lower closing lows, so that's typical. The Dow goes down on a percentage basis less when the market is really trending lower. You can see that by the relative strength line here, but still below all the moving averages. Mid caps, let's look at the MDY ETF. Didn't make a lower low, not a lower closing low either, so a little bit of relative strength there. And IWM, same thing, didn't make a lower low, didn't make a lower closing low. Value did outperform growth today, we do still have this hookup there also. And let's take a quick look at IWO. Still have the hook up there, and in fact, it didn't hook down today, showing even more relative strength. These are very small, subtle clues that the market may be trying to put in a bottom, and small caps and mid caps, and particularly the growth components of them, are trying to hold on, trying to lead, trying to put a stake in the ground, and work its way higher. We've got still a list of about 10 to 15 stocks. They're not all above the 21, but a lot of them are holding the 50-day moving average. Very common to correct to the 50-day moving average. But we'll be ready if the markets look like they want to put in a bottom and make any kind of a move higher. It's always darkest before the dawn in a bear market. There's always false starts. We'll get involved in those false starts, but we'll cut our losses quickly. It's okay to be wrong. It's not okay to stay wrong. So let's take a look at the tail of the tape. What's changed? Technical. I still have this in yellow because it's just attempting the hookup on the indexes and the G6. That's a little bit of a, I don't really like to use the term green shoot, but really that is what it is. It's a decent analogy for it. Put call at 1.13, VIX at 32. That's elevated on the VIX. Anytime you're above the 26 level, beware. Fear and greed all the way down to 15. That's making new lows. That's in the extreme fear range. Operating under the bear case. Some news before the market. Jobless claims hit a 5-month low. That's good news if you're looking for a job, but it's bad news if you're the Fed and you're trying to slow the economy and dull inflation. They've got a tough job ahead of them, and the markets are pretty much showing that day after day lately. Okay, so on the S&P 500, we went yesterday, day one up. Now we've got 1 day down. Tuesday overnight low has held 3602, so that's another slight positive. And the S&P is hanging right between this -5 to -6.5% below the 21. Earlier in the week we took a stab at this oversold condition, seeing if we could rally back up. We got the rally yesterday, gave it all back. Today we got stopped out with a very small gain on this play on Tuesday. But we're below now where we sold out. So confirming the weakness, I guess, is very appropriate to say. Expectations negative since that 921 breakdown, confirmed today again with the negative action. We did hold the support areas both on the S&P 500 and the NASDAQ 100, in fact, undercutting part of this range and then reclaiming it. Here are the overnight. Always keep track of these, the overnight and the opening 30 and 60-minute ranges, and the high and the low to see this, especially this 30, 60-minute and the overnight range. It tells you who's in charge, the bulls or the bears. If you're below the range, quite obviously the bears are in charge. If you're above it, then you're seeing strength in the market, and it gives you some more conviction to whatever side you're on, or make you question whatever side you're on. So we had that gap down today, closed lower. As I said, GROTECTION flat in cash. What was up today? Not a whole lot, but gold stocks, energy, XLE, only one component of the ETFs that we watch, and it was flat. It wasn't even up. DBA up just a fraction. That's agricultural commodities, and CTA, the managed futures. They're sticking with their trend up when the market's down because they're net short. On the downside, market down even with the dollar down, so that correlation, at least for today, didn't work. Bonds continue lower. After the big move down yesterday, though, we haven't made new highs, certainly. 10 out of 11 of the S&P sectors down. Retail weak, utilities weak, and semiconductors weak. Let's take a look at XLU. A lot of people think, I can just buy dividend stocks or utilities. Look at this. We actually were looking at a system. Would we be okay going short the indexes and long utilities and be able to squeak out some low risk profits there? No, because you get these big dramatic moves down in utilities, just like you do with every other sector, depending on what's going in favor or out of favor. Let's take a look at the VIX very quickly. You can see this consolidation of the VIX on the upside is very much in sync with just the opposite, this consolidation to the downside in the S&P. A break above this 35 level would kind of stand out like a sore thumb, and I think that that would correspond with a big break lower on the indexes. Let's take a look at bonds 0TNX. You can see an inside day today, meaning today's high and low were inside yesterday's high and low after that big move down yesterday, 6.5%. Still holding above the ADMA. If we break the ADMA, that's a change in character going all the way back to the beginning of August on the 10-year. Let's take a look very quickly at gold, GLD. Off the lows, not really making much progress, but it is showing relative strength over the last week and a half. And I did mention that GDX was up today. That still looks like trash, trending below the 21-day exponential moving average. If this can get above the 50-day moving average, and I'm going to adjust my stop right now on that, that would be a change in character and, in my opinion, would be worth a long on gold stocks. So you can see once we broke the 50-day moving average back here in April, which coincided with that big breakdown in the indexes. Also, people think gold stocks have to buck the trend of the overall indexes. They absolutely don't. But if they get above this 50-day moving average, they will be moving counter. And I would see that as a safety trade, very similar to GLD also. Every time it has come into the 50-day moving average since that gap lower at the beginning of April, it's failed. But as always, we'll keep an eye on that. Let's take a look at good old Bitcoin, BITO. This is the Bitcoin futures. Not really so nice here. Can't get above the 21 or the 50-day moving average and trending below the 200-day moving average. Also certainly in a risk off mode, but hasn't made new recent lows, unlike the market indexes. So back to the tail of the tape here. Where are we? Our focus continues to be shorting on bounces into resistance, but we can't get any bounces into resistance. So that's the main reason why we're staying in cash. No trades today, still in cash. Likely that we close the month out that way also, unless something really jumps out tomorrow at me. Bottom line, gap down, new closing lows, gave back all Wednesday's gains. Let's take a look at some new support and resistance areas here. Here with the gap down and the close at 36.40. So new area to monitor here. This one was on here. This is 36.02. That was the overnight low going into 9.28, 36.36 and 36.47. Those were recent lows on 6.17 and 9.23. This is a big area here, and we bounced here today at the top of this with the low being 36.10. So just like before, we talked about these 20% off of 3 levels year to date, the 25% off or pullback off of year to date or off of the closing high of 2022, which happened in early January, or off the absolute high that was made. There's a range in here from 35.75 to 36.14. These round numbers like this, I mean, the algos look at them and sometimes they react and they cause other things to react. But as of right now, we undercut just this one that's off of the absolute high of the year, 36.14. We undercut to 36.10 today and reclaim that. So these levels will be a little bit lower, and then 35.05 will be retracing fully half of the COVID rally off the bottom. If we go to the S&P 500 on a weekly chart here, you can see we're talking about this low of 2191 in March of 2020 all the way up to 481862 in early January of this year, and recollecting half of this. You're going to say, Don, that doesn't look like it's half. Well, that's because this is a the word is escaping me. It's a chart that oh my gosh, am I getting old? It is my 57th birthday today. It's a chart that makes equal gives equal length to the equal percentage move. So like 200 to 300 here is 100% move. 300 to 600 would be the equal percent of the move here. I want to say algorithmics, but logarithmic. Geez, I'm in these. Logarithmic chart. I sound like an idiot. Anyway, so this is a logarithmic chart. That's why it doesn't look like as if it's actually given up fully half of it. You can turn this into a standard chart, which we use for the daily charts. We don't use log for the daily charts. Anyway, geez, before I say anything dumber, let's wrap this up. So 3505, that's your 50% retrace off of the COVID low. So let's go back here because I'm going to wrap this up now. But first, I'm going to look at a couple of stocks to see what in the heck held up today. That's kind of close to our leaders list. Shockwave closed positive. Anything that closed positive, we got to look at. Look at that, trying to get back above the 21-day exponential moving average. We're not going to have 21 over 21 tomorrow unless something massive happens. We did get about 12 to 15 above yesterday. LNG is one of them. That's back above the 21-day exponential moving average, and that closed positive today. How about something that was really not down that much, like Palo Alto Networks, PANW, but that's trending below all the moving averages, but that 160 looks like a pretty good support level for Palo Alto. How about Vertex? Above the 21, relative strength at an all-time high. Let's check in on Biogen, which had that big move up yesterday on the Alzheimer's drug news, and at this point it looks like it wants to act like it did last time, which is, and I showed this on a weekly chart yesterday, it makes big moves on these announcements, which seem to be an overreaction, and then it gives it all back. Step one of giving it all back is closing below the low of the gap up day, and Biogen did in fact do that today. Let's see what Lilly did. I guess they have a pending Alzheimer's drug too. It didn't close below the low, but still finished lower. But then again, it is a bear market. So that's going to wrap it. As always, here's the contact info. We'd like to hear from you. Did I show my favorite chart today? I don't think I did, but this is why we cut our losses at Revere. Risk management is our first job. You take care of the drawdowns, and the gains take care of themselves when you get back involved. When the market goes into an uptrend, we want to absolutely avoid all of this. This is actually worse now. As I said, we touched minus 25% today. I'll update this chart when it becomes meaningful to update it, but severe losses average 44%, takes 80% to get back to even. Some advisors are okay with this. We at Revere are absolutely not, and we've got the partners, Danny and I, have all of our money and all of our family's money in this approach, so we fully back it. You could say Dan and I approve this message since we're coming into election season, and we will go with that. So wrapping up, September 29th, this is Don Vandenbord reminding you it's not how much you make, it's how much of that you can keep. Thanks for listening, and have a great day.